Oliver, we're about to get the third quarter reporting season underway for investment banks fairly soon, but already we're seeing signs that things are pretty tough, particularly on the trading side, which is a bit unusual given how choppy markets have been. What exactly is the underlying sort of thesis here?
So the markets have been choppy in a lot of areas, but the particular area of weakness for the banks is fixed income, currency and commodity trading. And this is where a lot of the banks have a lot of business, a lot of people devoted to that. And
yes, it's a very high-cost business.
It's very high-cost business, very people-intensive, very capital-intensive as well. So it's important that it goes well, and it hasn't been over the summer. Uncertainty over tapering and generally quieter markets have all taken their toll, and revenues in FIC trading are expected to have fallen over the third quarter. We've already had Jefferies in the US reporting that it didn't go well, and Barclays in the UK has also made some negative comments about it. And we're likely to hear a similar story from other banks when they report their third quarter numbers.
But is that being outweighed to any extent by advisory? Because there's been quite a big pickup in M&A, for example. I mean, we had the Verizon Vodafone transaction, for example, being just one very lucrative piece of M&A that happened this year. There's lots of IPOs, so primary markets seem to be in fairly good shape.
They are, yes. There is plenty of business around there. All those deal makers certainly have a spring in their step at the moment. As you say, the big M&A deals with all the underwriting that goes with that, if there is any, plus the IPOs. But it's not quite enough to offset the decline in trading income. Trading is traditionally a much bigger portion of income than advisory fees are. Advisories are quite small. It's nice, it grabs the headlines, it looks good in the newspapers for the banks, but it's not nearly as big a deal for them as the trading income is. So all that extra work doesn't quite cancel out any difficulties in trading.
But I suppose this is part of the new sort of shrunken investment banking landscape.
It is, yes, and what's very notable about it is that the bank that's done most to shrink its fixed income trading business, UBS, its shares have done particularly well in the past 3 months. They've certainly outperformed all of the other big investment banks. So it shows that perhaps that kind of radical restructuring is what investors want to see.
Okay, well, we'll certainly see when the third quarter reporting season gets underway in the next couple of weeks, whether the extent to which the trading environment has become very tough and how it's being balanced, if at all, by advisory. Thanks, Oliver.